Bitcoin has achieved significant milestones on its journey towards mainstream adoption, yet debates persist about its future role in the financial system. Is Bitcoin the future of money or just fool's gold? In this video, I'll cover everything that you need to know about Bitcoin, including the origins of Bitcoin, what Bitcoin is and how it works, the reasons behind its growing adoption, its criticisms, and its future outlook. This video is intended for informational purposes only and is not financial advice. I want to emphasize that Bitcoin is a very volatile asset and its price can fall just as fast as it rallies up. So who created Bitcoin and when? Let's start from the beginning. On October 31st, in the midst of the financial crisis, an anonymous individual or group of people under the name of Satoshi Nakamoto published a white paper titled Bitcoin, a peer-to-peer electronic cash system, marking the introduction of Bitcoin. The Bitcoin network officially launched on January 3rd of 2009, and the first Bitcoin transaction took place on January 12, just a few days after. As of today, no one knows who Satoshi Nakamoto is. Despite numerous investigations and widespread speculation, Nakamoto's identity continues to be one of the most intriguing mysteries in the cryptocurrency world. It is believed that Nakamoto mined about 1.1 million Bitcoins from 2009 to 2010. These Bitcoin were stored across numerous wallets, and these wallets remain inactive since Nakamoto's disappearance in 2011. Most people have heard about Bitcoin by now, but what exactly is it? Well, Bitcoin is a cryptocurrency, the first cryptocurrency. Crypto meaning hidden or secret because the transactions are secure and private, and currency meaning money. Bitcoin is also referred to as BTC because that's its ticker symbol on exchanges where you can buy or trade it. And it has a max supply of 21 million coins that no one has the ability to decrease or increase. Bitcoin is decentralized as it operates without a central authority like a government or a bank. Instead, it relies on a peer-to-peer network that is composed of thousands of nodes around the world. A node is a computer that runs specialized software, allowing it to verify transactions in the Bitcoin blockchain. Each computer or node maintains a copy of the blockchain, which is a public ledger of all transactions. Think about the blockchain or public ledger as a public digital record book of all the Bitcoin transactions. Since all nodes maintain identical copies of the blockchain, if someone attempts to alter a transaction, the majority of the nodes would reject the discrepancy and reject the transaction. This ensures the network security and that no one entity is able to stop the flow of Bitcoin's exchange. You may be asking, who owns the computers that make up the Bitcoin network? Well, the network of computers or nodes that verify Bitcoin transactions is owned by thousands of individuals, businesses, and Bitcoin miners. And if you choose to, you too can buy and host a node. That is, as long as it's legal where you plan to set it up. This decentralized aspect of the Bitcoin network is important because up to the creation of Bitcoin, all currencies in the modern world had been created and controlled by central governments and banks, which has made them vulnerable to manipulation and corruption. I'm going to elaborate a little more on who the individuals, businesses, and Bitcoin miners are. Individuals who compose the Bitcoin peer-to-peer network are enthusiast and privacy-conscious users who run full nodes to independently verify transactions and support the network's decentralization. While they don't receive direct financial rewards, their efforts enhance Bitcoin's network and it can indirectly benefit their Bitcoin-related activities. Now, businesses involved in Bitcoin transactions such as cryptocurrency exchanges and payment processors also operate nodes to ensure accurate processing and maintain control over their operations without relying on third parties. This practice helps them verify transactions independently, enhancing security and reliability in their services. Miners are the ones who do have a direct financial incentive to utilize specialized nodes to verify Bitcoin transactions and add new blocks to the blockchain. Adding a new block is how Bitcoin transactions become permanent. When people send Bitcoin, miners use powerful computers to confirm each transaction and ensure that it follows Bitcoin's rules. All valid transactions are grouped into a block. Miners then compete with their nodes to solve a complex mathematical puzzle, and this process is called proof of work. The first miner that solves this puzzle is the one who adds the block to the blockchain, which again is a secure public record of all Bitcoin transactions. As a reward for their effort, this miner receives newly created bitcoins known as block rewards and also fees from verified transactions. As of mid-March of 2025, approximately 19.8 million Bitcoins have been mined, leaving about 1.16 million yet to be created to reach the cap supply of 21 million coins. Bitcoin's network was programmed with a mechanism called halving, which reduces the rewards that miners get for adding new blocks to the blockchain by approximately half every 4 years. This systematic reduction slows down the rate at which new Bitcoin are introduced into circulation. Given this mechanism, it is estimated that the last Bitcoin will be mined around the year 2140. You may be thinking, Bitcoin's tech is cool and all, but why is it decentralized and why is it even valuable? Well, unlike traditional currencies issued by central banks, Bitcoin has a finite supply of 21 million coins. And because it's decentralized, no one has the ability to add more coins to the supply. So as Bitcoin gets adopted by more people, it becomes more valuable. In comparison, centralized government currency can be created and issued as the government chooses to do so. When this happens, the value of the currency gets diluted and everyone holding that currency takes that loss of value. Here's something to think about. A $15 meal in the US today would have cost 50 cents 100 years ago. And that change of price is correlated with the amount of dollars that the government has printed or placed into circulation from then to now. The reason people have placed value in Bitcoin is because there's only going to be those 21 million Bitcoin 200 or 1,000 years from now. Its value comes from people trusting that it will be worth more in the future as it becomes less volatile, more widely adopted, and not subject to the same inflation that government currency is liable to. Currently, government-issued currencies like the US dollar are more stable due to their widespread adoption and the relatively predictable inflation rates. Despite Bitcoin's growing adoption, it remains influenced by various factors, including regulatory developments, technological advancements, and broader market acceptance. While some envision Bitcoin replacing traditional currencies like the US dollar, its current role aligns more with that of digital gold. In order for Bitcoin to replace all government currencies, it would have to jump a lot of significant hurdles. For one, its current volatility doesn't allow it to work as a good medium of value exchange. Here's why. Let's say a car dealership sells a car for 1 Bitcoin, and that Bitcoin was valued at $100,000 during the transaction. It's very possible that that same Bitcoin could be worth $90,000 by the end of the day, and maybe $110,000 by the end of the week, and then $70,000 by the end of the month. That unpredictability in value makes it very difficult for businesses to use it since they have to account for profit and losses daily to run their business. But let's say the volatile problem is solved. There would still be the issue of having dominant governments reject the power that they currently hold by being able to control their own currency. As of today, the US government is leading in Bitcoin adoption through the current administration, but Trump has made it very clear that his intention is not to replace the US dollar with Bitcoin. My opinion is that we are more likely to see the US dollar converted into a cryptocurrency than we are to see Bitcoin replace it. Other hurdles in having Bitcoin become a widely accepted currency include high energy consumption associated with block creation, low transaction speeds, and high transaction fees. However, these issues could be addressed with off-chain transaction methods such as the Lightning Network. The Lightning Network allows you to send and receive Bitcoin by opening a payment channel which is recorded on the blockchain. But once the channel is established, you can conduct unlimited transactions between members of that channel without broadcasting each transaction to the blockchain. When the members decide to close that channel, the final balance would be broadcasted to the blockchain, and they would update their Bitcoin holdings accordingly. The legality of Bitcoin varies globally. In some countries, it's embraced and regulated, and in others, it's restricted and banned. Although not all Bitcoin transactions are public, BitBo, a company headquartered in Ontario, Canada, has gathered some data showing what countries hold the most Bitcoin. Most government holdings have been seized from criminal activity, but some countries like El Salvador have acquired them as part of their country's initiative to adopt Bitcoin as legal tender. The country Bhutan currently holds about 13,000 Bitcoins, which were primarily accumulated through domestic Bitcoin mining operations, leveraging hydroelectric power. The two countries holding the most Bitcoin are the United States, holding about 207,000, and China, holding about 194,000. As I previously mentioned, the current US administration is pro-crypto, and Trump has signed an executive order to make a Bitcoin reserve. But as of now, the reserve only holds the 207,000 Bitcoin that the government had seized from criminal activity. It is speculated that the US government will buy more Bitcoin, but as of now, there's no clear plan for that to happen. China, on the other hand, has been against crypto and currently upholds a strict prohibition on Bitcoin trading and mining, but it does legally recognize individual ownership of cryptocurrencies. Despite a stance against crypto, recent data indicates that China contributes about 55% of Bitcoin's hash rate, which is a measurement of computational power used in Bitcoin mining. Underground and covert mining operations persist in China, enabling the country to maintain a significant presence in the global mining industry. This ongoing activity has led to speculation about a potential policy shift. However, as of now, there's no official confirmation that China will lift its cryptocurrency ban in the near future. The adoption of Bitcoin by major financial institutions and the introduction of Bitcoin ETFs have significantly reinforced its legitimacy as an investment asset. These developments have simplified access for both individuals and corporations to invest in Bitcoin. In 2020, companies like MicroStrategy, Square, and PayPal made multi-million-dollar investments in Bitcoin. And in February of 2021, Tesla invested $1.5 billion in Bitcoin, making it one of the corporations holding the most Bitcoin, second only to MicroStrategy. By the end of 2021, the first Bitcoin futures ETF, ProShares Bitcoin Strategy, was approved by the SEC and began trading. Then on January 10 of 2024, the SEC approved 11 proposals from issuers, including BlackRock, Fidelity, and VanEck, to launch spot Bitcoin ETFs. Although Bitcoin adoption by major financial institutions and corporations has been positive for the narrative and price of Bitcoin, ownership is highly concentrated, with a small number of individuals, corporations, and governments holding a significant portion of the cryptocurrency. This centralization raises concerns about potential market manipulation and the stability of the broader cryptocurrency ecosystem. Here's some numbers that have raised concerns. Less than 2% of Bitcoin wallet addresses control over 90% of all the Bitcoin currently in circulation. And according to a study from the National Bureau of Economic Research, the top 10% of miners control 90% of Bitcoin mining capacity, with just 0.1%, which is about 50 miners, controlling 50% of mining capacity. The concentration of Bitcoin ownership among large holders, known as whales, enables them to manipulate market prices through substantial buy or sell orders. Additionally, centralization in Bitcoin mining, where a few entities control significant portions of the network's hash rate, poses risks to the cryptocurrency's decentralized integrity. Here's a few other aspects of Bitcoin that have raised concerns. As I had previously mentioned, Bitcoin can face rapid and substantial changes in price. These changes can result from a variety of factors, such as whales selling and buying large sums of Bitcoin, regulatory changes from government, macroeconomic conditions, market sentiment from news, institutional investments or sell-offs, security breaches, competition from altcoins, and geopolitical events. I'm sure there's more factors, so if you think I missed any, please mention them in the comment section below. If any of these factors cause negative sentiment in the market, it can create panic, causing Bitcoin's price to head in a downward spiral. As the price plummets, people start selling in fear of losing more money, which further causes panic in the market and triggers even more people to sell. Over the past decade, Bitcoin has continued to increase in value, but there have been multiple instances when it goes from its peak price to losing up to 75% of its value. And it has taken it multiple years to climb back up to its previous price. When this happens, it's referred to as the crypto bear market or crypto winter. If you buy Bitcoin, make sure that you're accounting for the possibility of this happening and only use money that you can afford to leave in the market long term or even lose. The Bitcoin blockchain has never been hacked or compromised. However, exchanges and individual wallets have suffered breaches due to security lapses. Here's some of the most common Bitcoin scams that you as an individual should be aware of. Phishing scams. Bitcoin scammers use emails, fake websites, or messages to trick individuals into revealing their private keys, passwords, or other sensitive information. To avoid these scams, you should always check the links and addresses that you interact with, and avoid interactions with anyone that you don't know. When signing up for anything, you should always check that the websites are official, because sometimes websites or emails can be off by just one character, so at first glance, you may think it's legit. Impersonation scams are also a big problem. Scammers also pose as celebrities or reputable figures, offering fake giveaways or investment opportunities that require victims to send cryptocurrency with the promise of receiving more returns. There's a form of impersonation scams called pig butchering in the cryptocurrency space. Fraudsters build long-term relationships with victims to gain trust before convincing them to invest in fake cryptocurrency platforms, ultimately stealing their funds. This can be led by accounts using fake pictures and videos of attractive individuals, or in some cases, it can even be led by someone that's willing to disclose their identity. Be very mindful of how convincing AI voice, photos, and even video has become when interacting with strangers on the internet. Blackmail and extortion schemes have also become common. Scammers claim to have compromising information about their victim and demand cryptocurrency payments to prevent the release of this information. The best thing to do if you encounter this scam is to just ghost the message. You don't want to get dragged into a back and forth with anyone. And if you really feel threatened or compromised, it's always best to just report it to the police. Also note that Ponzi and pyramid schemes are plentiful in the crypto world. These scams promise high returns with low risk by using funds from new investors to pay previous investors, creating a false appearance of profitability. Oftentimes, people get into Bitcoin and crypto when they hear everyone on the internet getting rich, which makes them buy into sketchy crypto projects out of fear of missing out. Just know that if it sounds too good to be true, it is. Now, I was surprised to hear about Bitcoin ATM scams, because who even uses Bitcoin ATMs? But apparently, scammers are impersonating authorities or service providers and instruct victims to deposit cash into Bitcoin ATMs, which then transfers funds to the scammer's wallet. Advancements in quantum computing have recently raised concerns about potential future security risks to the Bitcoin network. However, Bitcoin's open source protocol allows its global developer community to collaborate and implement quantum-resistant algorithms, allowing the network to adapt against emerging threats. It's more likely than not to see Bitcoin maintain secure and reliable transactions as quantum computing evolves, but it does remain a valid concern. Something to consider is that if quantum computing was able to bypass Bitcoin's cryptographic security, then Bitcoin wouldn't be the biggest concern, as all government networks and the financial system would be equally at risk. This makes me optimistic that developers will create security measures well before quantum computing is able to pose a threat. If you enjoyed this video and or found it helpful, please like it and share it with anyone who might benefit from learning more about Bitcoin. Also subscribe if you'd like to see similar content in the future. It would mean the world to me. Thanks for watching and have a great day.